Welcome to Have You Read It, the channel where we bring books to life, one summary at a time. Today, we're diving deep into Stay the Course, the story of Vanguard and the Index Revolution, by John C. Bogle. This isn't just a business book, it's a personal memoir interwoven with the history of one of the most influential investment firms in the world. Get ready for a fascinating journey spanning decades of innovation, struggle, and ultimately triumph. We begin with a pivotal meeting in 1974. Jack Bogle, then planning to establish Vanguard, meets with John Lovelace of American Funds. Lovelace's stark warning: creating a truly mutual fund structure, one owned by its shareholders, would destroy this industry. This prophecy, as Bogle points out, proved remarkably prescient, though perhaps it would be more accurate to say it would transform the industry beyond recognition. Lovelace couldn't foresee the impact of Bogle's unique structure, coupled with his revolutionary index fund strategy. His journey started at Blair Academy, a prestigious boarding school, where he excelled academically despite financial hardships. This early experience of overcoming adversity clearly shaped his character and determination. His Princeton thesis, The Economic Role of the Investment Company, laid the groundwork for his future convictions about low-cost investing and the limitations of active fund management. This thesis already showed an idealism that would become central to Vanguard's philosophy. After Princeton, Bogle joined Wellington Management Company, where he spent nearly 2 decades. His rise to the presidency in 1965 coincided with the go-go era of speculative investing. Bogle saw this trend as a departure from sound principles and a threat to Wellington's conservative approach. His attempts to merge Wellington with other firms to diversify its offerings ultimately failed. This period serves as a crucial backdrop to understanding his later decisions. The go-go era's high-flying speculative funds proved unsustainable, eventually giving way to the Nifty 50 craze of overvalued growth stocks. The subsequent market crash in 1973-74 resulted in Bogle being ousted from his position at Wellington. This seemingly catastrophic event actually turned out to be a turning point. It allowed Bogle to finally pursue his vision for a truly mutual fund company, Vanguard. The formation of Vanguard in 1974 was a complex compromise born out of conflict. It began as a fund administration company, initially barred from portfolio management and share distribution, essentially overseeing Wellington's operations. The choice of the name Vanguard, inspired by Lord Nelson's flagship, symbolized Bogle's ambition for the firm. It was a long shot. The mutual structure was a radical departure from the established norm, but it laid the groundwork for everything that would follow. The creation of the world's first index mutual fund in 1975 was a direct response to Paul Samuelson's challenge. Samuelson, in his article Challenge to Judgment, pointed out the lack of a low-cost, broadly diversified fund that simply tracked the market. This provided Bogle with both the opportunity and the motive. His unique structure, combined with the market's need, provided the perfect conditions for the index fund's creation. The initial public offering of the first index investment trust, later Vanguard 500 Index Fund in 1976, was a near failure, raising only a fraction of the expected capital. Despite the initial setbacks and skepticism, Bogle's folly, some called it, Bogle persevered, recognizing the fund's long-term potential. This highlights his resilience and commitment to his vision. The early resistance also illustrates the slow acceptance of new, potentially disruptive financial products. The subsequent elimination of sales loads in 1977 was another bold move, freeing Vanguard from its dependence on brokers and putting it on a path toward becoming a full-fledged mutual fund complex. This was not without its challenges, including a protracted SEC hearing that tested Vanguard's resolve, but ultimately served to highlight the fund's independence and dedication to the investor. This demonstrates the obstacles Bogle faced in trying to introduce new ideas, which required a lot of persistence. The 1980s saw Vanguard's growth accelerate, fueled in part by its successful entry into money market and bond funds. The creation of defined maturity bond funds, another Vanguard innovation, reshaped the bond fund landscape and solidified Vanguard's position in the fixed income market. The decade also included significant fee reductions across Vanguard's funds, a testament to the firm's commitment to its cost minimization strategy. The 1990s witnessed the triumph of indexing. The creation of the Vanguard Total Stock Market Index Fund and the subsequent launch of additional index funds cemented Vanguard's dominance in this rapidly growing sector. The creation of balanced index funds, followed by life strategy funds and target retirement funds, expanded the appeal of index funds to a broader range of investors. Bogle consistently emphasizes the importance of simplicity and cost efficiency in investment. The creation of the exchange-traded fund ETF presented both opportunities and concerns for Bogle. While acknowledging the ETF's potential to broaden the reach of index investing, he was wary of its potential to attract short-term traders and speculators. Vanguard's entry into the ETF market, led by Gus Sauter, was more cautious than its competitors, focusing on broad market index funds and avoiding more speculative products. This highlights Bogle's continued prioritization of long-term investment strategies. Bogle provides detailed histories of various Vanguard funds, including Wellington Fund, index funds, Windsor funds, prime cap funds, and bond funds. These chapters provide insights into the different investment strategies employed and the successes and challenges encountered. Each story illustrates important aspects of investment management, such as risk management, cost efficiency, and the importance of having a clear investment strategy. The Wellington Fund's history illustrates the pitfalls of straying from core principles, with periods of strong performance contrasted with severe underperformance. The eventual recovery of the Wellington Fund serves as a powerful illustration of the importance of staying the course with a well-defined investment strategy. The fund's eventual success also shows how long-term, diversified investments can withstand market fluctuations. The various index funds, starting with the Vanguard 500 Index Fund, showcase the remarkable growth and influence of passive investing. The creation of the Vanguard Total Stock Market Index Fund provided a more comprehensive approach to market tracking investments. Bogle's emphasis on low-cost investing is consistently reinforced throughout these examples. The contrast between index and actively managed funds provides strong support for the index fund's philosophy. The Windsor Fund's narrative highlights the success of a long-term value investing approach under John Neff's management, as well as the necessity of closing funds to new investments when they reach significant size. The creation of Windsor II demonstrates the ability to maintain a similar investment strategy while mitigating the risks associated with rapid asset growth. The prime cap funds illustrate the success of partnerships built on shared values and a commitment to long-term growth. The contrasting performance of Vanguard Capital Opportunity Fund under two different management teams underlines the importance of selecting and managing investment advisors. Vanguard's bond funds showcase the firm's pioneering role in creating defined maturity funds and index funds in the bond market. The comparison of actively managed bond funds and index funds provides a strong argument for the cost advantages of index funds. The emphasis on consistent, low-cost strategies appears again. Chapter 16 serves as a cautionary tale, exploring some of Vanguard's less successful fund ventures. This section highlights the risks involved in deviating from core principles, prioritizing marketing over sound investment strategies, and the importance of adapting to changing market conditions and carefully selecting fund managers. Part 3 of the book shifts the focus to the future of investment management. Bogle advocates for the mutualization of the fund industry, arguing that a truly mutual structure, where funds are owned by their shareholders, is essential for prioritizing investor interests. He highlights the conflict of interest inherent in the current structure, where management companies prioritize their own profits over investor returns. Bogle addresses the criticism of index funds, particularly the concept of common ownership, and its purported anti-competitive effects. He argues against proposals that would severely limit the holdings of large institutional investors, emphasizing the importance of broad diversification and the benefits of low-cost index funds for individual investors. He anticipates future legislation affecting the financial industry, proposing a Financial Institutions Act of 2030 to replace the outdated Investment Company Act of 1940. Bogle argues for a regulatory framework that addresses the changing landscape of the investment industry, including the dominance of index funds and the role of institutional investors in corporate governance. The overarching theme in Part 3 is the need to prioritize investor interests. Bogle consistently advocates for greater transparency, lower costs, and a stronger emphasis on fiduciary duty throughout the investment industry. The argument for low-cost index funds for long-term investors continues. Part 4 is a fascinating personal memoir. Bogle shares reflections on his life, his values, and the people who have influenced his career. This section of the book illustrates the personal values that informed Bogle's business decisions and his commitment to a wider societal impact. The focus on individuals and institutions that have played a significant role in Bogle's life creates a compelling narrative that complements the business story. The book emphasizes the importance of mentors, the value of hard work and determination, and the need for strong communication and leadership. Bogle highlights his personal and professional relationships and the importance of a strong team, particularly at Vanguard. This demonstrates the people-centric culture that Bogle prioritized in the creation and ongoing growth of Vanguard. Throughout the book, Bogle emphasizes the importance of staying the course as both an investment strategy and a life philosophy. It's about long-term vision, resilience, and a commitment to core values, which includes the need to understand that investment success depends on simplicity, low costs, and long-term commitment. The main takeaway from Stay the Course is that long-term investment success is best achieved through a strategy of low-cost, broadly diversified index funds. Bogle consistently demonstrates that high costs significantly erode investment returns, and that a disciplined long-term approach is more successful than attempting to time the market. Some easily remembered heuristics from the book include strategy follows structure, costs matter, stay the course, shareholders first, relative predictability. Thanks for watching. Make sure to give this video a thumbs up and hit that subscribe button so you never miss our next book dive.